Hello and welcome. My name is Austin if you're new here, and I'm a certified financial planner practitioner. On this channel, we help educate you on complex financial planning topics. If you like this video, give it a thumbs up and subscribe to our channel for more helpful content. In part one of this series, we talked high level about stock to bond asset allocations. But in this video, we're going to talk about different types of sub-asset allocation mixtures and what to consider when constructing a portfolio. So how do you know what types of stock to include in your portfolio? Well, in order to avoid having all your eggs in one basket or in different sectors of the market, research has shown the benefits of diversification and having a portion of US and international investments. International investing is going to be more inherently risky, so it's typical to have a greater portion of your assets in US investments on both the stock and bond side. So for international, research has shown that international can help. It can be helpful to have a balance of both developed and emerging markets. Developed nations are going to have more advanced economies, better developed infrastructure and capital markets and things like that. Emerging markets are going to be economies in the process of rapid growth or development. The typical ballpark answer of how much you would want to have in developed markets would be about maybe 80% of your international portion and perhaps 20% in emerging markets. Now that can be different for different people depending on your risk tolerance, so that's not a one-size-fits-all answer, but that's typically the right range. In the US market, the US market is broken up into three main categories called large cap stock, mid cap stock, and small cap stock. And the large, mid, and small really just has to do with the size of the company you're investing in. Most of the US stock market is composed of large cap companies in the neighborhood of about 70%. They're going to be a little bit safer when compared side by side with mid and small cap. They're going to be a little bit less risky, your blue chip companies. So it's typical to have in the neighborhood of 70% in large cap and 30% in mid to small cap. But again, that's not a one size fits all. It depends on your risk tolerance and your goals. On the bond side, it can be helpful for diversification to have both US and international bonds. It's not for everybody, but international bonds do provide diversification. In the US market, investing in bonds means investing in government bonds from the US government and also corporate bonds for corporations. Corporations like Bank of America or Apple or AT&T, any company can issue corporate bonds. They're going to be a little bit more risk and a little bit more reward for a corporate bond compared to a government bond like the US government. And then on the international side, you're going to have international bonds as well. And the typical split that you would have would be a ballpark of about 70% in US bonds and 30% in international. Again, that can vary based on the investor and their risk tolerance, but that's the typical split. All right, hopefully this has been a helpful overview for reviewing sub-asset allocation of bonds and stocks. Thank you for watching. If you have questions about what you've learned, click the link in the description to learn more about our firm and how we can help.